Brazil invented the future of money, and the United States is trying to stop it. In November 2020, Brazil's central bank launched an instant payment system called Pix, free, instant, available 24/7. 5 years later, 175 million Brazilians use it, 93% of the adult population. Last year, Pix processed 64 billion transactions, surpassing the combined volume of all debit and credit card transactions in the country by 80%. Nobel Prize-winning economist Paul Krugman said Pix may have invented what cryptocurrency only promised. This is not a story about a payment app. This is a story about how Latin America, a region most investors ignore, is quietly building the most advanced financial infrastructure on the planet. And nobody in the English-speaking world is paying attention. To understand what's happening, you need to understand what came before. For decades, Latin America's financial system was designed to extract wealth from the poor, not to serve them. In Brazil, 5 banks controlled 84% of all lending. Credit card interest rates exceeded 400% annually. Monthly account fees, transfer charges, 4-hour branch lines, banking was a punishment. Nearly 34 million adults had no bank account at all. In Mexico, 68% of the population had no access to a bank account. In Argentina, more than 60% of adults had no credit card. In Colombia, half the population was outside the formal financial system. Across the region, roughly 200 million adults were completely excluded from banking, not because they didn't want financial services, but because the system was never built for them. And then smartphones arrived. Latin America's fintech revolution didn't start with a Silicon Valley playbook. It started with a government payment system in a country most Americans can't find on a map. Pix didn't just replace cash, it replaced the need for a credit card. 60 million Brazilians don't have a credit card, but over 170 million use Pix. It gave small merchants, the street vendor, the barber, the taxi driver, the ability to accept digital payments instantly for free through a QR code on their phone. No expensive card terminal required. But Pix is just the infrastructure layer. The companies being built on top of it are where the real story is. You already know 2 of the biggest names if you've watched our previous episodes. Nubank, 131 million customers, 16 billion in revenue, built from a house in Sao Paulo by a Colombian who decided to fight Brazil's banking oligopoly. And Mercado Pago, 78 million monthly active users, processing $278 billion in payments annually, embedded inside Latin America's largest commerce ecosystem. What connects all of these companies is a single insight. In Latin America, fintech isn't competing with good banking. It's replacing the absence of banking. When you're not disrupting an incumbent's product but filling a vacuum that the incumbent refused to fill, your addressable market isn't their customers. It's the entire unbanked population. That is 200 million people. Here's where consulting frameworks actually help explain what's happening. There are 3 structural advantages that make Latin American fintech fundamentally different from fintech in the United States or Europe. Advantage 1, the cost gap is a moat. Nubank serves 131 million customers with 8,000 employees at a cost of $10 per customer per year. Brazil's largest traditional bank, Itaú, spends $219 per customer and operates nearly 43,000 physical locations. That is a 22 times cost disadvantage that Itaú cannot close without abandoning its branch network, which would mean losing its existing customers. This is the textbook innovator's dilemma, and it's playing out in real time across an entire continent. The numbers tell a story that most investors haven't heard yet. The Latin American fintech market was valued at $76 billion in 2025 and is projected to grow to over $125 billion by 2033. But these are conservative estimates that don't capture the full picture. Of course, there are risks, and being honest about them is what separates analysis from hype. And competition is intensifying. Traditional banks aren't standing still. Itaú has 17,000 technology professionals. Bradesco launched a digital-only brand. Santander is investing heavily in digital infrastructure. In Mexico, Banorte is building its own digital banking capabilities. The easy phase of disruption, acquiring the completely unserved, may be ending. The next phase, competing for the primary banking relationship, will be harder. But here's the thesis that I think most investors, most analysts, and most media are missing. What's happening in Latin American fintech isn't just a regional technology story. It's a preview of how the next billion people will interact with the financial system globally. The pattern is replicable. Governments in Africa, Southeast Asia, and the Middle East are studying Pix. India's UPI, which inspired Pix, is already processing billions of transactions monthly. The combination of government payment rails plus private fintech innovation, plus massive unbanked populations, plus smartphone penetration is a formula that applies to dozens of countries. The dysfunction was the catalyst, and the companies that emerged from it, Nubank, Mercado Libre, Rappi, dLocal, Voila, are now exporting their playbooks to other emerging markets. Latin America isn't behind, it's ahead, and the rest of the world is starting to copy its homework.